Welcome to Dr. SNS Rajlakshmi College of Arts and Science. Warm greetings from SNS family. This is Dr. J. Vijayalakshmi, Department of Commerce with Computer Applications. In this slide, I am going to explain about the differences between IFRS and Generally Accepted Accounting Principles (GAAP). So the basic differences between Generally Accepted Accounting Principles and the FIRS. GAAP is the accounting standard set by the Financial Accounting Standard Board for the Securities and Exchange Commission in the United States. It is a rule based system. All domestic and other traditional based companies will follow the process and procedures. Both individual and corporate investors can analyze the company's financial statements and make an informative decisions whether they can invest in a reputed and profit oriented so both plays a very important role. So according to the purpose of the gap is to help the investors analyze financial data and compare the different companies to make the informed financial decisions. So, what are the international financial reporting status? IFRS are the accounting standards set by the International Accounting Standard Board, guidelines followed by 15 to the G20 countries like China, India, and Indonesia do not follow the IFRS accounting standards but have similar standards. While Japan allows the companies to follow IFRS standards if any choices based on the choice basis. What while GAAP and the IFRS both have how financial documents and structure are filled, and they both offer improves the comparative income and reporting. There are significant differences when thinking about the difference between IFRS and GAAP. Two main differentiations are there. That is, GAAP is a rule based, meaning publicly traded US companies are lawfully required of following directive and processes, whereas GAAP is US based, while IFRS is used worldwide. So these are the basic differences and between the IFRS and GAAP. The inventory valuation methods. The purpose there are three standard accounting methods and inventory valuations. One is first in, first out methods, while assuming the first or the oldest item in your inventory will be the first to be sold. The last in, first out, that is LIFO method, while assumes that last newest latest one item in your inventory will be the first to be sold. The weighted average method, which uses amount earned from the selling portion, can be your investors determines the value of remaining portions. So a GAAP and IFRS. So GAAP allows the companies to use any of the above three inventory valuation methods. While using the FIFO or GAAP uses the net assets value to determine inventory valuation. This is calculated as the total value of the company's assets minus the total value of its liability. Whereas IFRS allows the FIFO and weighted average method but does not allow the LIFO method because LIFO can be manipulated and it must be discloses the LIFO method based on can be manipulated to destroy the company's earning to lowest tax liability. While using the FIFO and IFRS uses the net realization value. This considers how much an asset might generate while sold minus and establishes the cost. So fees and the taxes associated with the sale. So let us see about the cash flow statement. A cash flow statement is a financial statement that shows the previously how cash and cash equivalent enter and exist the business over a specific reporting period. GAAP and IFRS handles the cash flow statement differently, particularly in how they classify interest and dividends. So, the GAAP and the IFRS interest paid and received as well as received dividend are to be classified, while dividend paid are listed in the financial sectors. IFRS all interest and dividends can be listed under the operating of the financial sections. So, apart from this, there may be a classifications and modern technologies are to be used. So, these are the basic differences of the IFRS